Hi everyone, my name is Dr. Brian Winrow. I'm a tax attorney and tax professor, and what I'm doing today is I'm talking about built-in gain and built-in loss. So what is built-in gain or built-in loss, and why do we even care about this? All right, so remember when we were talking about 721 transactions, we said there was no gain or loss recognized whenever we put property into a partnership, and in return what we're getting is shares in the partnership, a partnership interest. Well, what we said as far as basis in that situation is our outside basis, remember that's our basis in the partnership interest, is going to be our adjusted basis of the property that we contributed plus cash and liabilities. But the key thing is our adjusted basis in the property contributed. And then we said the inside basis that the partnership takes, so the basis in the asset that the partnership takes, is the adjusted basis of the property that we contributed, right? Well, what's going to happen is eventually our partnership is going to dispose of that asset, or maybe it's just through depreciation over longer periods of time, but we're looking at it from disposing of that asset. They're going to eventually sell that asset. Well, if the contributing partner had a fair market value of $100,000 and an adjusted basis of $80,000, that means that our partner only really is invested in $80,000 in terms of their tax basis on it. The other 20,000 was likely due to appreciation or something like that. So what we have to do is, if our partner is taking an $80,000 basis, their adjusted basis, in their outside basis, and the partnership is taking an $80,000 inside basis, well, when the partnership sells that asset for $100,000, what's going to happen is they're going to have $20,000 of gain. Adjusted basis from the selling price gives us $20,000. Well, if you have, and you would have multiple partners in a partnership because you have to have at least two or more people. So what's going to happen is if we have $20,000 of gain, if we're now going to allocate that gain to all the partners based on their ownership interest, what our contributing partner was able to do is take 20,000 of appreciation because it was deferred. They never recognized gain on that appreciation, and they've shifted a portion of it to their contributing partners. So they're escaping taxation for their full amount of value. Had they sold the asset, they would have gone 80 minus 100, and then our partner would have had to recognize that 20,000 and they would have paid taxes on it. Well, the code is sitting there saying, listen, we're not going to let you go ahead and share or try to offset that and allocate that to another partner. What we're going to do is we're going to actually make sure that that $20,000 of gain, built-in gain, is going to be allocated back to the contributing partner. Now, what we're going to do in this video is we're going to go ahead and we're going to work through two examples. And as we see the numbers, this should start to make sense in terms of why we care and how we handle these situations. So let's go ahead and take a look at our first example. All right, so let's go ahead and take a look at our first problem. So what we are looking at here is we have a problem where we have Lori and Tammy create White Sands Partnership in a 721 transaction. Remember, it's a non-taxable transaction. It defers our gain recognition. Tammy distributes cash of 100,000 and Lori contributes land that has an adjusted basis of 55,000 and a fair market value of $100,000. So this is going to be a built-in gain type of problem. Okay, so we have our built-in gain here. So what are we talking about when we're looking at a built-in gain? Well, look at our adjusted basis is 55,000. Our fair market value is $100,000. There is a difference of $45,000, right? So what that means is when Tammy invested in this property, she only has that adjusted basis of 55,000. Maybe she's been depreciating the property depending how it was being used, or maybe she just bought it at $45,000 and due to just holding the asset, it has increased in value to $100,000. So that gain is all appreciation. Well, we know from our foundations of tax that we don't recognize on the appreciation of property, right? There has to be some type of taxable event that's going to cause us to recognize the realized gain or loss. Sorry. So what we're looking at is she's only paid taxes on 55,000. It's $100,000. So imagine a situation to where we allowed this to go. We see that Tammy has contributed $100,000 of cash, right? Tammy has been working hard at her day job. She's been saving away diligently, and then she pays taxes every time she gets her paycheck. She puts that money away, and now she has $100,000 and she invested it. She's paid taxes on all $100,000. Okay. Well, now all of a sudden we're sitting there saying, "Hey, Lori, we're going to let you contribute fair market value of 100,000, so 50-50 owners, they both contribute something of value of $100,000. But Lori, you've only contributed or paid taxes on 55,000. So when the partnership's eventually going to sell this asset, say for $100,000, look what's going to happen. There's $45,000 of gain. Well, doesn't it make sense that Lori should have to recognize that $45,000 of appreciation and that Tammy should not have to worry about paying any additional taxes? I mean, after all, Tammy's already paid taxes on $100,000 worth of the property. And now what we're looking at is Lori should be paying her taxes on her own $100,000. If we don't have some kind of rule that allows us to avoid this, then here's what's going to actually happen, right? What we would do is we say, well, there's $45,000. Well, what the code would do is they would say, okay, Tammy, you have to pay taxes on 22,500 of the gain, and Lori, you're going to pay taxes on 22,500. That's unfair, right? Because Tammy's now paying taxes on really $122,500 for her $100,000 interest there. And what's happening is we're having Lori only pay, what is it, $75,600 on the taxes or so? Not the full amount, right? So the code handles this, and we're going to walk through this example and show you how we're going to deal with this. But I'll tell you that built-in gain is going to be allocated to Lori. Lori's going to pay taxes on any built-in gain. Lori and Tammy are both 50% partners in the general partnership. Assume the partnership eventually sells the land for $120,000. Allocate the land, the gain and loss to Lori and Tammy. Okay, here we go. So Tammy, 50% owner, contributes $100,000 of property. Lori, 50% owner, contributes the basis with with 55, the fair market value of 155, and we talked about her built-in gain being $45,000. That's simply the difference between the fair market value and the adjusted basis. This 45,000 has not been taxed. It has not been taxed yet. Okay, so we have to tax somebody on that $45,000 of gain. Now, because it's a 721 transaction, we deferred recognition until a future event. Well, that event is going to be, in this situation, the sale of that land. Okay, so here's what we're looking at. We have a sales price of 120 that was given to us up in the facts right up here. So we have a sales price of 120, right? And we'll just, oops, let me get rid of that for you. I was trying to get it just so you can see where the 120 came from, but not too far down. So we had the 120,000 for the sales price. Our adjusted basis, right? That was $55,000. We had that in here. It was given to us in the problem. So we have $55,000, a sale price of 120. That means there's a recognized gain of $65,000. So we have $65,000 that the partnership has that they now have to allocate to each partner so the partners can recognize their share of the gain or loss, right? Here is just gain. So 120,000 sales price minus the adjusted basis of 55. Okay. So what we have to do then is we have to say, okay, how do we handle this? Well, we're going to say that that $45,000 of built-in gain, the first thing we do is we allocate that to the contributing partner. That contributing partner in our situation is Lori. So Lori, you're not going to get away with this. You need to now recognize that $45,000. So we have allocation to the partners. We have Lori right here. We're taking all $45,000. That was the difference between our adjusted basis and fair market value. Boom. Lori, you're paying the taxes on that. Then what we're going to do is we're going to say, okay, we've handled $45,000 of this. So what do we have left? And if we look at this little note here, the post-contribution increase in the fair market value, we sold it for 120. The fair market value was 100. it appreciated by $20,000 while the partnership owned it. Well, if there's appreciation while the partnership owns it, that's fair to go ahead and allocate to each partner because it was a partnership asset at that time. So we have out of that $65,000 of recognized gain, okay, out of that 65,000, we've already addressed with 55,000. I'm sorry, we have already addressed 45,000, right? The difference between the built-in gain there. So we've already dealt with the $45,000. And now what we're going to do is we're going to take that additional $20,000 and we're going to allocate it based on the ownership percentages of our partners, 50% in this example. So we're going to say the post increase in the fair market value is going to be $10,000 for Lori, and for Tammy it's going to be $10,000. So we can now add this up and figure out how it's allocated, the total allocation. 45,000 for Lori for the built-in gain plus 10,000 post increase gives Lori $55,000 that she's going to have to pay taxes on. In Tammy, well, there was no built-in gain. Tammy got her 10,000 of appreciation while the partnership owned it. So she only has $10,000 that she has to pay taxes on. Okay? What we've done now, if we look at this 55 plus this 10, that equals 65,000. Hey, did you notice that that is our total recognized gain? So we have dealt with all recognized gain. We've allocated it to each partner. Now, here's something that kind of confused me when I first started learning this years ago. I was like, wait. So you mean that because Lori put in property that had appreciated and she hadn't paid taxes on it, Lori's going to get $55,000 of cash and Tammy's going to get $10,000 of cash? How does that work? Right? That's not what it is. When I was learning it, that was a mistake that I kept making, and I had to untrain myself on this because what we were dealing with is we're dealing with the allocation. So basically, what we're saying is this is their distributive share. It's not how much cash they're getting. In all likelihood, what's going to happen is they're 50-50 owners, they're both going to get half of that amount of money, right? They're both going to get their $32,500, so 65,000 divided by 2, 32,500 apiece. They're both going to be enriched by that amount, okay? But what we're doing is we're saying, hey, who's paying the taxes on this distributive share, right? How are we dealing with this distributive share? So now we can say, Tammy, you're not going to have to be responsible for half of that built-in gain. That Lori, you're going to pay that entire built-in gain. So we're not deferring it any longer. Lori, you pay this. Okay. And what's going to happen? Let's look at it from Lori's perspective, just to take this a step further to make sure you're comfortable with this stuff. What's going to happen is Lori's going to pay taxes on $55,000 because that's going to be her distributive share. So what we will do is we're going to increase Lori's basis, outside basis in the partnership by $55,000. Okay, because she's now paid taxes on it. So we increase her basis. And if you think about it, it makes sense. And here's why. So remember when we said that Tammy contributed cash with $100,000? Well, Tammy got a basis of $100,000. Her adjusted basis in the property contributed is her basis in the partnership interest. So she has a basis of 100,000 for putting in property worth $100,000. So she can take out distributions and everything else and it's not going to be taxable on her, right? Okay. Well, when Lori went ahead and put in her property, she took a basis of $55,000. Okay, that was fine because she wasn't recognizing any gain. But now that we are allocating those 45,000 and she's paying taxes on it, hey, now look at, she's really paid taxes on her 55 plus her 45. If you're paying taxes on this, we increase your basis. So we're basically increasing her basis to the $100,000 now that she's paid 100,000 taxes on $100,000 worth of the asset, right? So the same as where Lori was. Now, what will happen is we increase it by an additional 10,000 because it appreciated by 10 additional thousand. So we increase it by 10,000 more. So now her basis, assuming no other events occurred, her basis is now going to be 55 plus 55. She's going to have a basis of 110,000. And Tammy had a basis of 100,000 from the cash she contributed, and now Tammy increases her basis by an extra 10,000. So Tammy now has a basis of 110. They both have a basis of 110. Now, those aren't always going to add up. Sometimes, like Lori or Tammy may be taking out distributions throughout the year. They want to take out a withdrawal or whatever. So bases can adjust. They don't have to match. In this situation, it does because we're assuming nothing else occurred. All right, y'all. I think we've taken care of this problem. So let's look at one more problem. And what I want to look at is what happens if there's a loss, a built-in loss instead of a built-in gain. So one more problem here, and we'll wrap this up. All right, well, let's take a look at our second problem. Like I said, we're doing the built-in loss, right? So we have Lori and Tammy create White Sands Partnership in a 721 transaction. Tammy contributes cash of $100,000, so we left Tammy alone. And Lori contributes land that has an adjusted basis of 130,000. So now we increase our adjusted basis. So it's going to be 130,000 with a fair market value of $100,000. Ah, what's that mean? It means that perhaps Tammy bought this asset for $130,000 and she's been holding it as an investment and it's just gone down in value, right? The market hasn't been what she thought it would be. So the fair market value, she's going to sell it in an arm's length transaction to an unrelated party. She's only going to get $100,000 for it. Okay. Well, that means that we have a $30,000 built-in loss. Lori and Tammy are both 50% partners in their general partnership. Assume the partnership eventually sells the land for 95. Also, it even went down further. They sell it for $95,000. Allocate the gain and loss to Lori and Tammy. Okay, 721 transaction, which means that when Lori put this property in, she took an adjusted basis of the same adjusted basis in the property that she had, and the inside basis of the partnership is going to be the same basis that she had. So her outside basis and the inside basis are both going to be $130,000 because that was her basis. So we're taking $130,000 for both of those. All right. Well, had she actually sold this instead of contributing in a 721 transaction, then she would have recognized $30,000 of loss, and then she would have been able to recognize that on her taxes. But because it's a 721 transaction, it was put in for the partnership interest, what happens is it's a non-recognition, so it was deferred. Now, eventually, we're going to have the partnership sell it for $95,000. So with this land, which isn't a depreciable asset, we're going to go ahead and we're going to take a look at it and see what happens. So the basis that they have is cash was $100,000 for Tammy. We didn't change that. The adjusted basis was 130, so that's going to be Lori's new basis and her new outside basis, and it's going to be the partnership's inside basis. We have a fair market value of $100,000. So, like I said, that's been a $30,000 built-in loss. And you can see we're eventually going to take that $30,000 built-in loss. If you follow the arrow, it's going to show us that it's going to be used in part of our allocation. Because just like a built-in gain, we're going to allocate the built-in loss to the contributing partner. Okay, so Lori contributed, and it makes sense because what happened is when Tammy contributed $100,000 of cash, she paid taxes on that 100,000 as she earned it or whatever. And Tammy has paid taxes on 130,000, but they're both only getting credit because they're a 50% ownership. They both put in something of value of $100,000 because the value is whatever the fair market value is, right? So that $30,000 loss is going to be allocated specifically to the contributing partner, and that contributing partner here is going to be Lori, so that's where we're getting the $30,000. Okay, so let's take a look at this. The loss on the sale of the land. So eventually we sell it for $95,000. So it went down even further here. Our partnership's adjusted basis, the inside basis was at $130,000. So we have a recognized loss, right? The sale price is lower than our adjusted basis. We have a loss of $35,000 when we subtract those out. It's $35,000 loss. Okay, so of that $35,000 loss, what we're going to do is we have to take the built-in loss of $30,000 and we're going to allocate that over here to Lori. right? That's what we're going to allocate to Lori. She gets the $30,000 of loss. That's allocated to her. Now, if we take out the 30,000, look at there's a post contribution decrease of 5,000. So 30,000 of this was going to be built-in loss, and the other 5,000 of loss continued to increase, continued to decrease. And I should have put a little parentheses there for you so you know it's a loss, but it was a $5,000 loss. Well, the continuing decrease occurred while the partnership owned that property. So if there's $5,000 of losses and they're 50% partners, then what's going to happen is 2,500 will be allocated to Lori, so half of that 5,000, and then half of the 5,000 will be allocated to Tammy. And if you follow those two arrows over here, you can see that that's exactly what I did. Okay, so our answer now becomes how much of the loss is going to be contributed to Lori? 30,000 built in plus the continued depreciation in the asset or the decrease in asset of 32 of 2,500. That comes out to 32,500, and Tammy is going to decrease hers by 2,500. So if we add these two together, that's $35,000. Hey, that was our total loss over here anyways. That was our recognized loss. We allocated all $35,000 to our two partners. So we know we're doing it correctly, or at least that's evidence that we're doing it correctly. Um, Now, what's going to happen here? Well, we have a loss, and that's going to decrease our basis. So we're going to decrease the basis for Lori by 32,500, and we're going to decrease the basis for Tammy by $2,500. Okay. Well, why are we decreasing it? So what's going to happen is this loss right here, because it's a loss, we're going to go ahead and it's going to go to our K1. So it's eventually going to get to our 1040. So right away, we're going to be able to have Lori recognize this. And then Tammy's going to be recognizing her 2,500. So Lori benefits from these additional losses, the allocation of losses, because it offsets her other income. Now, I talked about passive activity loss and passive activity limitations before. Well, in this problem, is showing that she was or is leading you to believe that she is a active participant. So we don't have the passive activity loss restriction in there. So we only have to make sure we have sufficient basis and we have to make sure that we have sufficient at risk, but we don't have to get to the passive activity loss rule. And because this is an active uh, business, she's active in it, she can then use those losses. She doesn't have to look for active income to offset those losses. Okay. So she's going to be able to recognize those right away. That's the way that we handle our built-in gains and built-in losses. So I hope that these videos are helpful to you. If they are, please subscribe to my channel, like the channel. If you have questions or anything, feel free to comment in the comments as well. Thank you.